Hi, and welcome to today's session of Lunches with Legends, where we connect with some of the most illustrious individuals in the financial world while supporting the vital healthcare organizations in our community. Before we begin, I'd like to thank our key sponsors of this series, especially our Gold Series sponsor, KPMG. We are deeply grateful to KPMG for their friendship and very generous support. We would also like to thank our three Silver Series sponsors, Ventura Realty, the Cregan McConnell Group, and TD Bank. We are so appreciative of your generosity. I just want to remind everyone that 100% of the dollars you donate through Lunches with Legends goes toward COVID-19 relief and pediatric mental health. So if you have not already made your donation, please take a moment, go to the donation page at the top right of this site. We would be most grateful for your support. Now, without any further ado, I'd like to introduce our very special guest today, the legendary Howard Marks. To give you a little bit of background, so Howard, who holds degrees with distinction from Wharton and University of Chicago, launched his career with various investment leadership roles and positions at Citigroup. After 16 years at Citi, he joined TCW Group, where he led various investment teams as the Chief Investment Officer for domestic fixed income. In 1995, Howard co-founded and currently serving as co-chairman of Oaktree, which is one of the largest asset managers in the world, managing approximately 150 billion and employing over 1,000 people, being particularly renowned for their distressed debt and credit investing expertise. Aside from earning the fiduciary trust of the world's most respected investors, Howard has also been an extraordinary thought leader of his many books. Of his books, my personal favorite is The Most Important Thing: Uncommon Sense for the Thoughtful Investors. On a personal level, I've given away dozens of copies of this book and really believe it's required reading for all capital allocators. But on top of that, his most recent book, Mastering Market Cycles, and on top of that, he really shares his famous memos, which are eagerly consumed in every corner of the financial world. And if that wasn't enough, he's also a professor of practice at King's Business School in London. Philanthropically, Howard has been deeply involved with higher education and the arts, serving as the trustee and chairman of the investment committee at the Metropolitan Museum of Art. He serves on the advisory board of Duke Kunshan University and the investment committee of the Royal Drawing School, and is an emeritus trustee of the University of Pennsylvania, where he previously chaired the investment board. Ladies and gentlemen, I am so excited for this conversation, and it gives me great pleasure to welcome our distinguished guest, Mr. Howard Marks. Howard, thank you so much for joining us.
Well, thank you, Mo, for having me. And I feel at home because I'm an honorary Canadian now that we have partnered with Brookfield.
That's right. That's right. So we're going to get to that, and I'd love to dive into that. But before we do, many of us have been reading your memos and books for years, and some of the brightest minds in the industry. I mean, for God's sakes, even Warren Buffett says you're one of the few people he reads without fail. And on top of that, you've also endowed, I believe it's called the Marks Family Writing Center at the University of Pennsylvania. So it seems like the written word and simplifying complexity has some, resonance with you, or unique resonance with you. How did that come about? Like, what in your upbringing might have contributed to that resonance?
Well, as a child, I don't remember any particular emphasis, although my parents did emphasize language. In other words, they cared about words, and we had fun with words when I was little. I think the most formative experience was when I went to University of Pennsylvania as an undergraduate. I was a finance major at Wharton, but at that time, Wharton had a very enlightened requirement that you had to have a non-business minor, and you had to take one course in the literature of a foreign country. And for some reason, back in 1965, which I can't remember the reason, I chose, most people took either French or English or British, or I guess those two. And for some reason, I chose Japan. And I took my required course in Japanese literature and loved it so much that I made it my non-business concentration, Japanese studies. And I took 15 credits in there. And the main professor for 4 of my 5 courses was a kind of an aesthete, an Oxford Don, but he put great emphasis on writing. And if he didn't like something, he'd say, write this over, or you bad sentence structure, wrong word, those days we didn't have word processors. If he said do it over, that means type it again on a typewriter. But I think that raised my writing. And then when I started work at the bank, I concluded that one way you could distinguish yourself was if you wrote better than everybody else. So that was helpful. And as you know, in 1990, I started writing the memos for some unknown reason. But I enjoy writing. It's a creative outlet for me. And if you look, you'll see that there's usually a memo in January and a memo in September. And that means that I wrote over Christmas vacation and I wrote over the summer. And I'd rather be writing than sitting on the beach.
Great. Could do both, I guess, theoretically, but and thank you for all those memos. They've informed all of us in kind of our own understanding of the financial world. So let's come to Oaktree. So you founded Oaktree some more than 25 years ago now, and you've done many more things right than wrong, and have a remarkable track record. But I guess if I'm curious, if you were restarting Oaktree today, what might you do differently? And by the way, if the answer is nothing, perhaps I could ask you what might have been the most enlightening mistakes you made along the way. But let's see, what would you have done differently if you were restarting Oaktree today?
Well, of course, I always think about the movie Back to the Future. And you remember the guy who traveled back to the past said he wouldn't change anything, because if he changed the past, the future may be different. I mean, what now is and I feel that way. I wouldn't change anything. Having said that, I started work at Citibank. I reported for a summer job in the summer of '68, full-time job in the summer of '69. And the bank subscribed to what was called Nifty 50 investing. Most of the banks did. And by the way, the banks were the big investors at that time. There were no boutiques and so forth. So the Nifty 50, we invested in the 50 best and fastest growing companies in America, companies that were so good that nothing could ever go wrong, and so good that there was no price too high. Mm-hmm. So we bought without reference to price. Didn't work out so well. If you bought the stocks the day I got to the bank and held them for 5 years, you lost almost all your money. Wow. Investing in the best companies in America. And so, it was informative, but traumatized. One of my sayings is that experience is what you got when you didn't get what you wanted. And as I say, informative, but traumatizing. And then by 75, I was the bank's director of research. But the performance was terrible because of those things. And, the 5-year record was terrible. The 10-year record was terrible. And so the bank brought in a new chief investment officer who wanted to bring in his own director of research. So he said to me, what do you want to do next? Well, I felt that he'd give me a break because he didn't fire me. And I said, well, I don't know. I said, but I don't want to spend the rest of my life choosing between Merck and Lilly, because I believe in the concept of market inefficiency. And I think you can't choose between Merck and Lilly profitably. He said, I'd like you to start a convertible bond fund, because he used to work at JP Morgan where they had one, and Citi didn't have one. He says, I'd like you to start that. So I go from managing a big department with a big budget, and I'm on all the important committees, to working by myself with no budget and no committees. And I'm the happiest guy on earth, because all I have to do is read information on companies and figure out which ones are better. And it was really an obscure backwater of the investment world. And you could find incredible bargains. I mean, giveaways, literally. And I could tell you about some of them. But now I'm investing in the worst public companies in America, and I'm making money steadily and safely. Especially when I got the call in the summer of '78, August, from the head of the bond department. He says to me, there's some guy named like Milken or something like that out in California, and he deals in something called high yield bonds. Do you think you can figure out what that means? And I was smart enough to say yes. And in '78, I started Citibank's high yield bond fund, which was the first, I believe was the first high yield bond fund from a mainstream financial institution. And that was the beginning of the high yield bond era, '77, '78. And it revolutionized the world. Prior, the emphasis of investing was to invest in the best companies. And either what they used to say gilt edge or the Nifty 50, which were the best and fastest growing, or at least 90% of all investment organizations had a rule against buying bonds that were not investment grade. So what does that mean? So that means when they started to be issued, they weren't received so well, and the few of us who would buy them would get a special deal. Mm-hmm. And I was probably better suited for fixed income than I was for equities. I was very good at preventing losses and not so good at making money. So fixed income is the place. I say that as background because being traumatized early in your career by big losses and then finding comfort in fixed income with the where you give up upside to secure the downside, connected with me. So we started Oaktree. So and by the way, so I started with converts and high yield in 78, and then distressed debt in 88 when my partner Bruce Karsh joined me, and we branched out into other fixed income strategies, credit strategies, they call it today. We didn't call it that then. And so when Bruce and I and three other fellows left TCW in 95 to start Oaktree, we did the same business. The point is, though, that everything we had done was about going into these risky asset classes with the risks under control. And when we drew up our investment philosophy, we put risk control first, consistency second, et cetera. Mm-hmm. My point is that we have a great business most of the time. We tend to excel in bad times, which is when you get the greatest bargains, especially in the distressed debt business. But we are not a good horse for prosperity. And we don't have many prosperity-oriented strategies. So the big mistake, I'm sorry it took so long for me to get there. But the big mistake is that we have had, in horse racing, there are mudders and which do best on a bad track. And then you have horses that do best on a good track. We do best on a bad track. And right. we didn't diversify. Probably the biggest single movement of the last 40 years was the creation of the private equity industry. And we could easily have had private equity within our circle of competence, and we didn't.
And so I'm going to come back to the specific capabilities and how you're managing risk today. But let me just touch on something that's probably top of mind for many of us. A couple of years ago, you wrote the book, Mastering the Market Cycle, right? Getting the odds on your side. And you've obviously thought deeply about market cycles. But then after the book came out, we were confronted with this global shutdown, rapid drawdown, rapid recovery, just an experience like no other. So how has the last 12 months impacted your thinking about cycles? In other words, if you were rewriting that book today, what would you add? What would you take out? Or what would you want to highlight?
I don't think I would change much. I don't forget what I said on the subject, but I would make a very explicit mention of the fact that I believe in cycles, but not everything is cyclical. The important thing to note if you're studying cycles is that the pandemic and the market collapse and the government actions and the market recovery, none of that had anything to do with cycles. That was a non-cyclical event. I believe that most cycles in the economy and in the markets occur because although these things, companies and markets and economies have a positive underlying trend line, but if being on the trend line is a balance of optimism and pessimism and fear and greed, the point is that people and let's say that the trend line is indicative of fair value. The point is sometimes when things go well, people get more optimistic, and let's say the market price line goes above the trend line, and it gets too optimistic, And that I would call an excess. And then the error of the excessive optimism becomes clear when things don't go as well as people expected. And then it turns down back toward fair value. Well, it was overvalued at the high, if you could figure it out when that was. And then so you had an excess and a correction. Then it gets to fair value, but it keeps going out of a rising tide of pessimism and bad events, and it goes down to a low quite far from fair value. That's another excess to the negative side, and then it corrects eventually back to the trend line. So I think of cycles as excesses and corrections, and the raw material for these excesses and corrections is endemic. It is part of the economy. People, the participants in an economy get too optimistic, build too many factories. Then it turns out there's no need for the factories, and they sit idle, and then that depresses people, and then they get pessimistic. So and same for the market. Enthusiasm takes stocks to irrational highs, and then they correct, and when people are overly depressed, they go to excessive lows. So the raw material for cycles is endemic to the thing that is cycling. But that wasn't descriptive of last year. Last year, there were no excesses in the economy. The market was okay, but nobody thought it was terribly overvalued. And then we got hit with a meteor, which was the pandemic. Exogenous event, had nothing to do with the decisions that economic units had made in the economy, or the excessive bullishness on the part of investors, and it was totally unpredictable. So that doesn't change how I think about cycles. But what I would do is I'd put a big warning label: is that there are things other than cycles that matter. And so the knock to the economy was man-made. We had the pandemic, and we closed the economy in order to prevent spread. Mm-hmm. Then the recovery was man-made because the Fed and Treasury came out with big stimulus packages and rate cuts and bond buying and all that, and the market recovered. Man-made. I say man-made, meaning intentional creations so that wasn't cyclical, and I don't think it changes the way to think about cycles. But the point is, there are things to think about other than cycles.
Well, just to pick on that point, so man-made markets, let's call it, certainly rates, and certainly, what are some of the second-order consequences of monetary and fiscal policies that most people aren't considering? Like,
sure. Well, the obvious one. So one of the things that the Fed cleverly did that really helped is that they took the interest rate, Fed funds rate, to zero. Now, see, what happened is that the Fed learned a lot, and the Treasury learned a lot in the global financial crisis, and they developed tools to fight the weakness, and it took them months. But this time, since they had them in their arsenal, they did them in weeks and days. And in the global financial crisis, it took, I think, 11 rate cuts to take the Fed funds rate from 5.25% in September of 2007 to zero in January 2009. And so it was a protracted crisis. This time, they took it from 1.5% to zero in one cut in March. Boom, really shock therapy. And that changed the markets. It makes people want to invest because they don't want to have their money in cash. It lowers the demanded return on assets, which means an increase in price. It resurrects risk taking, because the only way to get a good return in a low return environment is by taking incremental risk. And it caused the capital markets to reopen because people had money to put to work. And the crises that I've managed money through 3 crises in the past, and they were all marked by big debt crises and a lot of defaults and the ability to buy a lot of debt cheap, especially in distress. And that didn't happen this time. I mean, it was on the way to happening, between, let's say, March 9th and the 23rd, but the Fed came out on 23rd and said, we're going to do even more than we had said. And the market started to go up on March 24th, and it's gone almost straight up since. So now, you did ask what are the negative consequences. So number one, low interest rates, artificially low interest rates, and I think zero is artificially low, reward risk takers and penalize savers. That's very important. And, how would you like to be working on a fixed income, and out of conservatism, you put your money into T-bills or short treasuries? And how would you like to have the banker call up and said that the return on your account is now zero? So that's number one. Number two, when the Fed rides to the rescue, it creates, the first really activist Fed chairman, as far as I'm concerned, was Alan Greenspan, starting in the mid-90s through the late aughts, or the mid-aughts. And we used to talk about something called the Greenspan put, because anytime there was the slightest ripple of unpleasant events in the economy, Greenspan would squirt in some more liquidity, which would save the day. He did it with Y2K. He did it with the tech bubble bust. He did it repeatedly. And so people started to reach the conclusion that they can always count, if there's a problem, they can always count on the Fed to bail them out. Well, that leads to something called moral hazard. And moral hazard is the belief that it's okay to do risky things because there's somebody who will bail you out. And of course, as you can imagine, that leads to bad behavior. It leads to risky behavior if people believe that there are no negative consequences for risk. And in one of my recent memos, I mentioned that bankruptcy is to capitalism as hell is to Catholicism. And if you're not scared of bad consequences, then you will engage in undesirable activities. So that's a real risk. And it's happened now twice in a row. People may really be swayed by that. Then the real consequence we have to worry about is the long term. Last year, the Fed increased its balance sheet by $2.7 trillion to buy bonds in the market, which supported the market. And the Treasury probably expanded the deficit from, it was probably going to be 1.2 trillion before the pandemic, and it turned out to be close to 4. So another, let's say 2.7, just to be up. So 5.5 trillion of extra liquidity was pumped into the system last year just by printing money and given out to citizens and given out to businesses and so forth. And I think the Fed is continuing to buy bonds at the rate of 1.5 trillion a year. And the deficit, I think, is going to be in the threes at least for a few more years. And so that's another, let's say, 5 trillion a year for at least 2 years. So we'll have pumped in at least 16 trillion of extra liquidity in 3 years. So here's the question. What will be the consequences? Now, there's something called modern monetary theory, which says that for a country which is in control of its currency, you don't have to worry about deficits and debt. Do you believe that? Can you really, add, well, it'll be 60, 70% to the national debt in 3 years, and add so much to the economy, so much liquidity without consequences? Seems too good to be true to me. Can you pay for infrastructure and raises and benefits and all kinds of relief with money you don't have ad infinitum without consequences? It's hard for me to believe. So, and what would the normal consequences? What would classical economics say will be the consequences? Will be increased inflation, rising interest rates, a weaker currency, maybe downgrades of the U.S. credit, and downgrade of the U.S. dollar status as the reserve currency of the world. But the Fed is unworried, and they express a lack of concern with inflation. So who am I to say they're wrong? But there's now a theory called modern monetary theory, and I think it's exactly that. It's a theory, but the Democrats who are now in control are using it to justify spending massive increases in the deficit.
So look, Howard, let me bring that home a little bit, like down to since all of the participants of this series are either active investors or family office principals. I think it would be fascinating to hear, and everybody would be interested in learning how you're investing your own money in your own family office today. Like, what do your allocations say about your belief, or how do the beliefs you've shared translate into your allocations? And if you have legacy positions, perhaps you could answer how might your portfolio look differently if you were building it from scratch today?
Yeah, I really didn't have much in the way of legacy positions because I turned negative at the end of 2004, began to turn negative, and I didn't have any investments. I liquidated everything. If it wasn't at Oaktree, the stuff at Oaktree I left because I have confidence in it, and also it was mostly in closed-end funds, so I had no choice, which was okay. But everything else, every penny I had outside of Oaktree, I put into treasury notes, 1, 2, 3, 4, 5, 6 year maturity. We call that a ladder. And you put equal amounts into several years, and that means you always have one note which is within a year of maturing. And the distant one gives you a locked up rate for 6 years, but the closest one gives you money soon. And when it comes due, you buy it, it goes to the back of the line, and you buy another 6 year, and the 6 year becomes only 5 years, and so forth. It's the dumbest form of investing known to man. But I was making between 5 and 6% that way with no risk in what I thought was a deteriorating environment. I was ecstatic. But anyway, the point is that through going into the global crisis, I had all treasuries. So when the crisis was over, it was time to create a portfolio, and I mostly went into more Oaktree funds, but also a few others, most of which didn't work out very well. But so my current portfolio, so I don't have legacy positions, but my current portfolio consists of two parts. We have a very good allocation of labor in my family because I manage the conservative part and my son manages the aggressive part. Yeah. And my part, the goal is to produce income and steady returns. And I would say on average today, I'd be very happy if I could make 8% or 9% a year steadily from credit products. And my son invests in equities and dare I say cryptocurrencies. And he's trying to knock the cover off the ball. And he's very hardworking, and he's very creative, and he's doing very well so far. So that's what we have. We have equities, and we have he's in charge of making money. I'm in charge of not losing money. And, I used to invest almost all my money to not lose money. But now we have a division of labor, which is excellent. And, he sees upside that I never saw. Maybe it was the reasons I described earlier, the trauma of my first experience, or maybe I was never that much of a dreamer or an optimist. He is. Right. And he's probably going to prove to have been too optimistic, just as I was too pessimistic, or too cautious, I should say. But I think we have a good balance.
And so given, if you think about that, like your targets historically, and you were ecstatic with 8% or 8 to 10% or what have you. And you've generally delivered a very healthy and sort of competitive returns through your Oaktree, variety of Oaktree funds. Just given the implication for all risk assets in a low rate, low return environment, how are you managing the return expectations of your investors? In other words, in the years ahead, where do you expect to find the yields or the returns, anything akin to what we've seen over the last few decades as rates were falling?
Let me clarify one thing before I go on, Mo, and I hope you'll remind me of your question. But Oaktree, which started off with those three categories and an emphasis on risk control, maintained the risk control, but has branched into other fields of investing: distressed debt, real estate, private equity,
Mhm.
emerging markets. Now, the common thread is that we continue to do all of those with the same emphasis on risk control. But we started, when we started Oaktree, I wrote down a motto, which says that if we avoid the losers, the winners take care of themselves. And that's a very good motto for fixed income. In what I call more aspirational asset classes, avoiding the losers is not enough. You have to find some winners. And we have made that transition, and our closed-end funds for these more aspirational investments have very good records in the double digits for the long term, net of fees. So we've done it, and I don't want to give the impression that all of the strategies are as conservative as I am, but they all have this overlay of insisting on risk control and consistency.
Mhm.
So now I'm ready for your question, which is,
Yeah, and maybe I should have clarified on the more conservative end of the spectrum of the strategies that you employ, which could be in high quality credit or potentially even interest rates and even equities. When we're in a high valuation, low rate environment, what are the return expectations that you're setting for your investors?
well, look, the most important thing for everybody to know is that I believe we're in a low return world. And, there's this thing called the capital market line. It looks like this. And it goes from the lower left to the upper right. You have return on the vertical axis and risk on the horizontal axis. And the line goes like that, which is what we call a positive correlation, an upward sloping line from lower left to upper right. Most people think, well, what does that mean? It means that riskier assets have higher returns. That's baloney, because if riskier assets could be counted on to produce higher returns, they wouldn't be risky. So there must be something wrong there. And when you hear somebody say, well, if you want to make more money, the way to do it is to take more risk, there's something wrong there. What they should be saying is, if you want to make more money, you should go into riskier securities to have a chance of making a higher return, but also a chance of losing money. Mm-hmm. As you go out the risk curve, your range of outcomes becomes wider, and the bad ones become worse. That's the nature of risk. So remind me the question.
Yeah. So I'm curious about the expectations you're setting.
Expectations, right?
Given that returns have historically been higher than what we anticipate in the years ahead.
So you have the capital market line. It goes like this, and it starts at the left axis, which is zero risk, with something called the risk-free rate, which is usually the 30-day T-bill rate. Mm-hmm. And it proceeds up from there, because every time you increase the riskiness of the apparent riskiness of something, you have to increase the apparent offered return, or else nobody will buy it. So that curve has to be upward sloping. People are risk averse. They're not going to accept a riskier investment at the same prospective return as a safer investment. They want an increment of return possibility. So it looks like this, and it starts from the risk-free rate. And for when I started managing money in '78, the Fed funds rate was 9%. But the thing is, rates have come steadily down for the last 40 years. I have a note on the wall of my office saying that I had a loan outstanding from a bank, and it says the rate on your loan is now 22 3/4. And last year I borrowed some money at 2 1/4. So the point is that the Fed, especially late last March, pulled down the risk-free rate from whatever it used to be, maybe 3, 4, 5 was normal, pulled it down to 0. The whole curve follows. And now the relationship between risk and return along the curve is still logical and fair, except that all prospective returns are now lower than they used to be. So I do a presentation about it, investing in a low return world. And it has a last slide, which says, well, what do you do? How do you invest in a low return world? And it used to have 6 bullet points. Now it has 5, because I took out the first one. The first one said, invest as you always have and expect the same returns you always made. But that was facetious, because that's out the window. I took that one off. The first one now says, invest as you always have and accept that your return will be lower than it used to be. The second one says, reduce your risk because you think we're in an uncertain world, and accept that your return will be lower still. The third one says, if you're really concerned about a correction in the markets, eliminate your risk by going to cash and acknowledge that your return will be zero. The fourth one says, rather than those three, let's go in the opposite direction. Let's increase the risk in order to get a higher return in the low return world. But is now, in an uncertain world where prospective returns are so low, is that really the time to increase your risk? Or number five, try to do better by investing in what I call special niches and special people. That is, corners of the market where you can get a better deal if they exist, and people who are capable of finding them for you. But all of these have limitations. And the last one, which sounds great on paper, the risk is that most of your investments then are going to be private. So you have the risk of illiquidity. And these are alpha markets where you're dependent on the skill of the manager. And if you hire the wrong manager, you're going to get negative alpha. So you have manager risk. None of them is risk-free. But you know what that means, Mo? The bottom line is that in a low-risk environment, there can't be a safe, dependable way to get high returns.
Right.
So you have to it basically comes down to saying, I don't want to increase my risk and I'll settle for low returns, or I'm willing to increase my risk in pursuit of high returns. But there's no low risk, high returns strategy unless you can find special niches and really special people.
So let's double click on that, because look, the reality is most people in a world where $16 trillion of cash has been flushed in, they're not going to sit on their hands and say, well, it's going to be naturally, I'm losing money by sitting here. Yeah. And most people want to see some return. They want to exceed inflation, whatever it is. So let's talk a little bit about those special niches and special people. I actually found it fascinating. In your last memo, you kind of advocated this, breaking this rigid dichotomy between value and growth investing, right? And you talked about the need for today's investors to actually factor in more qualitative as opposed to quantitative considerations, using more good judgment about the future, potentially being in these niche areas. So, and then on top of that, by the way, investors need to stay current on those qualitative and predictive considerations and keep finding those niches. That seems to be a lot to ask from investors. So what would you say are the characteristics of those that are capable of this and those that aren't capable of this? And what else might distinguish the winners or losers in the environment that we're in?
Well, obviously, look, there's a book called Lake Wobegon, written by an author named Garrison Keillor. And Lake Wobegon is this fictitious town. I think it's probably in Minnesota, if I'm not mistaken, where, quote, all the children are above average. And as we know, even though most investors claim to be in the first quartile, they can't all be in the first quartile. You have to be able to really do what, to really be able to increase return without commensurately increasing the risk. You have to have an exceptional investment ability. That's the only place it comes from. It can't come from, in my opinion, it can't come from a methodology, an algorithm, a computer. It can't there's no magic solution to the question of diversification versus concentration, or all these important questions that bear on a portfolio. I think I wrote a memo in 2015 or so about where these things come from. Where does superiority in performance come from? It comes from superior insight. And, I know superior investors, and they have a superior ability. And this was one of the themes in the book on cycles. A superior investor is superior because she has a superior appreciation for when the odds are in her favor as opposed to against her, and for individual investment situations that embody more return potential than they do risk. And the superior investor just sees those things better. So there's lots of different kinds of people who are good investors. and from many different backgrounds and with different methodologies. But methodology alone will not do it. It has to be whatever methodology, you need an appropriate methodology. There are many, there's not just one way to skin the cat, but you need somebody to operate that machine who has above average insight. It's an innate skill, I think. Some people just get it better. And there are a few people who tend to outperform for long periods of time, not consistent, not every day, because there's no approach that will work, that will succeed in all years. But the great investors have great long-term careers because they have it, and most people don't. And by the way, because most people don't, that's why the passive investment industry and the indexation industry has grown so much, because you had thousands of people managing money for fees where only the few people with superior insight can earn their fees by definition. So I think that's the most important thing. Thinking at a different level than other people and better.
Right. So what does that practically look like? Like when somebody has greater predictive capacities, because so much of today's valuations are in the growth businesses and the venture side of the equation, where God forbid we actually have an earnings number, because then we'd have to apply a multiple to it, and that would be so. Valuations are kind of being pulled out of thin air. How do you distinguish those that actually have that unique ability to that have greater insight? Like in terms of, in your son's case, as your son is sort of managing the growth side, how do you adjudicate, or how does he adjudicate where those growth potential is going to come from?
Well, that's obviously a very key question, Mo, and a very good one. I came across something last night for some reason. It popped up in my feed or something, or YouTube, and it was a recording of what they said was Warren Buffett's first interview on TV, and it must have been in the mid-60s. It was conducted by a guy named Adam Smith, which was a pseudonym for the writer of the book The Money Game and Super Money, and books that were classics in the 60s. And Buffett said, I don't think of in buying stocks as buying pieces of paper, because I think they'll go up next year. I think of buying stocks as buying a piece of a business, and I'm not going to sell it next year, and I don't care if it goes up next year. If it turns out I bought a piece of the right business, I'm going to make money in the long run. So if it's very hard with companies that have no profits. And remember, back in the 20 years ago, or 21 years ago, it was very easy to raise money for companies that had no sales. But now I think what you have to do, you have to think about what might it has sales today. What might the sales grow at? What's the size of the market? How much can it penetrate the market? And what share of the market will this company get? And then what might be the profitability? What could the profit margin be? And so forth. And the reason it has no earnings today is because they're spending a lot of money on acquiring clients and developing new products. If they did a little less of that, what might the profitability be in 10 years or 15 or 20 years ago? So you have to make those judgments. Now, you can't make them with precision or reliability, but you have to have some sense of the range. And if you can talk about what the profits might be in 15 years, you can kind of think about what you pay for that. If you can't, then there's no milestone to judge the price to pay. So I think you have to have some of that. Now, it's really interesting. Last April, I was scheduled to come to Toronto to participate in Prem Watts's growth value investing conference. And of course, it was canceled because it was the very front end of the pandemic. And I was starting to think about value investing to speak at that conference, and what would I say? And I was thinking about how value investing has evolved. But if a year ago I'd had that talk, what I might have said is, what are the characteristics of, quote, value investing, maybe with a capital V? What is that theology? And what I would have said, I think, is, basically mundane companies, not future innovators, with moderate growth, not the fast-growing high techs, with a high degree of predictability and stability, where the story is in the here and now, not some conjecture about the future, with high level of reinvestment of cash flow, and I should say with a good return on reinvested cash flow, but lots of free cash flow, and a low PE ratio. I think you're nodding. Do you agree? Okay, so that is classic capital V value investing.
Right.
But if you think about what are the essential principles of value investing, which I enumerated at the beginning of page 2 of that memo, the essential characteristics are thinking about investing as owning a piece of the business, and thinking about what it could produce in the future, and thinking about the fairness of the price relative to that potential value, and buying when the price is below the intrinsic value, but not buying when it's above. That's value investing. Doesn't say anything about having to have low earnings growth, having to avoid tech. Many people say tech and value are not companionable, but it doesn't say that. Why can't, and what about low multiples? Why does value investing have to be buying mundane companies at low prices? Why can't it be buying good companies at what look like high prices today, but are going to be low tomorrow? And in fact, Buffett has changed his tune. Buffett used to practice something that we call cigar butt investing, and I'll return to that. Well, I won't return to it. Cigar butts investing is the belief that you can find cigar butts in the gutter with a few puffs left, and you can get them really inexpensively because they're in the gutter. And Buffett has talked about buying dollars for 50 cents. But Charlie Munger, his partner, leaned on him and convinced him over time to change his tune and stop going for cigar butts. And Buffett later said, I'm not that interested in buying fair companies at low prices. I want to buy great companies at fair prices. So Buffett does not, for a long time, he barred technology, but then he invested in Amazon and made a lot of money a couple of years ago. And but he's made a lot of money in Coca-Cola, which was a growth company. So he's not insistent that value investing has to be about low growth and low multiples. Coke was not a cheap company.
Yeah, I think at the end of the day, I think the challenge for most investors is really when you talk about above or below intrinsic value, what the hell is intrinsic value? And that's really the challenge that most traditional value investors face when thinking about high growth, technology businesses.
Right.
Can I turn the conversation to something different? You talked about your son Andrew, and who's also a successful capital allocator, and you credit him with kind of updating your thinking on investing. Succession and education of the next generation is kind of top of mind for a lot of our families. What advice would you give those on the line, that you've kind of learned in terms of succession and educating the next generation that our families might be able to apply to their own children and grandchildren?
Well, I personally think that it's not what you say, it's what you do. It's how you live your life. And you can't, kids are not going to do what you tell them to do. They're going to do what you demonstrate for them. So I think one of the most important thing, both my kids are very responsible about money. and thoughtful, they're different. My daughter's tight and my son is loose, but they do it thoughtfully. But I think the reason is we always talked about money at the dinner table, not in a gross way, showy way. And we didn't say how much money do you think he has or she has, but we talked about how money can be used and what it can accomplish and how you should think about it and that kind of thing. And we had financial discipline with our kids, but not draconian. And I think that the single most important educational tool for children is the dinner table. That's the main time you get them and their attention. And we used to talk about things at the dinner table. And my son happened to enjoy talking about business. Maybe he was, from maybe 10 years old, maybe he was, or 12, but maybe he was trying to emulate me, or maybe it really interested him, but he's always been interested. And so you must instill values early. When we set up trusts for our kids, a lot of people, I know I have partners who set up trusts for their kids. They get a little at 30 and some at 35 and most of it at 40. But we gave our kids access to their money the whole way, right away. Because I believe that if you install the values, the rest is okay. And if you don't have, if the kids don't have the values, isn't it a shame that you have to lock up the money for decades?
Right.
So it all goes down to values.
Interesting. And similarly, I guess if I could, you've served on many boards and management committees throughout your career. And recently you, as you said, you're an honorary Canadian by virtue of being a director of Brookfield, but what principles or behaviors do you think make great or terrible governance that you've seen? And maybe if you could, which of those lessons could be applied within the context of families?
Yeah. Well, interesting. Especially those last few words. We all have our own personal opinions and our biases. I happen to be anti-committee. When I was 29 years old and became director of research at Citibank, I was immediately on 5 committees that met 16 hours a week, and I would climb the walls because I have a limited attention span and sitting power. And I felt that those hours, those committees, the meetings lasted as long as the person who wanted to speak the most wanted to speak, especially if he was the senior on the committee. And so I'm kind of anti-committee, and I wrote extensively about my opinion of committees in a memo called Dare to Be Great in 2005 or 6, and it wasn't pretty. But so at Oaktree, we primarily have no committees. We don't have a central investment committee. We decentralize the investment power to the group heads who form a committee if they want. And as far as I know, there's only 1 or 2 of our groups that have committees. I think that, Dave Swenson, who manages the endowment at Yale and has done a fabulous job for over 30 years and killed, investing is a game of inches. He's killed everybody else by yards. He wrote a book called Pioneering Portfolio Management, and he had a great quote in there. And he said that investment management requires non-institutional behavior from institutions, setting up a conundrum. I think that's great. Just think about that, because we're talking about companies, pension funds, universities, charities, and they are by nature bureaucratic. It's not the people's own money. It's the entity's money, and the people who work are called agents. And that's a word we use for people who are not investing their own money. They're agents. And so they have a tendency to develop institutional behavior. And we all know what we mean by the word institution. It's not a compliment. My dad used to say that marriage is a great institution for people who like to live in institutions. But what does institutional behavior mean? And one of the things it means more than anything is it's the importance of avoiding embarrassment. So I believe, I've been doing this a long time. I believe it's safe to say, and I don't think it's unfair to say, that for most institutional investors, the operative rule is I would never invest so much in something that if it didn't work, I'd look bad, or it would go down as a big mistake. But if that is your rule, and I understand that in certain settings, that's a good rule to have for self-preservation. If that's your rule, you have to accept that that means you'll never invest enough so that if it works, it'll move the needle. Right. What does that lead to? Over diversification. So I believe that most institutional portfolios are over diversified, and they have a little bit of almost everything because they don't want to miss an asset class that performs, but they don't have so much in the ones they think are better, and they still have some in the ones they think are worse. If you want to be an exceptional investor, by definition, you have to commit real dough to the things that you think will work, and not much, if any, to the ones that you feel less good about. So, for example, I think that in the 90s, when index funds were transitioning from non-entities to the importance they have today, and in the 90s, they were maybe halfway on that trip or something like that. I think that everybody said, well, let's put, we have 40% in equity, let's put 2% in an index fund. It's lip service. Can't make a difference. Today, what's one of the biggest issues in investing is how much you're going to put in China. So they say, well, let's put in 9% in emerging markets and 2 of that in China. And if China turns out to lead the world in 15 years, 2% is not enough. So, you know, you and I could probably agree on the decisions that today will determine whether we have a great performance or a terrible performance. And how much to put into China is one of them. But if that's true, then it's unlikely that the right answer is 2. Mm-hmm. And I would say to invest 2 in China, you have to be very pessimistic on China. And if you're optimistic on China, you know, maybe it should be 10. But you have to invest enough to make a difference. And I think when I join a new investment committee, I go through the portfolio and I circle all the positions that are less than 1%. And they all have a lot of them. And why have them? They're probably more work than they could contribute to the outcome.
And so, you know, that's a great segue. And I know we're sort of coming up to the edge of time here, but maybe if we could close off with, you mentioned China, and I don't know if that's just by virtue of an example, but broadly speaking, given all that is happening in the world today, what are you most excited about? What are you most excited about today? And as you look to the future, which potentially dramatic changes are you thinking about the most?
Well, I don't know if you noticed up there in Canada, but we have a new administration in the United States that I think will lead to a better 4 years and more harmony and hopefully try to heal some of the division, although the cultural divisions are very difficult because they are fed by the mass communications that we have and the stratified communications. I'm optimistic about how life can be improved by technology, both information technology and biotech. And, you know, the other fields of life are going to be changed in massive ways that we can't anticipate. And I think, and I'm a China optimist. So those are the things that I feel great about. And you know, the things that worry me are the effect of automation on working people. Where are working people going to find jobs in the future? Because you know, we tend to offshore repetitive jobs, and we're going to an information economy. How many workers do you need in an information economy? Productivity goes up. In theory, you need fewer workers. Where are people going? And we have more people all the time. So where are they going to find jobs? I worry about that a lot. And I worry about society and you know, healing the ills, and especially racial inequalities, which are important in the United States. I worry that we have this rise of political correctness, so that, you know, in most universities, you can't bring in a conservative speaker. They'll stone them, you know, or the students will sign a petition that they don't want that kind of stuff. So how are we going to discuss these things, and how are people going to learn about both sides of the story? And I worry about, you know, how we're going to. And the government in our country has become so partisan that the main goal of each party is to make sure the other doesn't accomplish anything. And I don't think that's a good outcome. So those are the kinds of things I worry about. I think markets will go up and down. I don't worry about that.
But the society, that's so virtually all of the concerns are socially focused.
Yeah. Let me say one thing. I'll give a pitch for some memos. By the way, they're all free and they're all on the Oaktree website. So it's not going to turn out that great for me. But in the summer of '08, things were actually pretty quiet a month or two before the Lehman bankruptcy. And so I wrote a memo called "What Worries Me," and you might look there. And you know, I was thinking about things like some of these then. And then in talking about institutional behavior and committees and that kind of thing. So I mentioned that I wrote "Dare to Be Great," I think it was '06. And then in, I think, 15 or 16, I wrote "Dare to Be Great 2," in which I said, talking about institutional behavior, I said the main thing is, if you want to be a great investor, you have to dare to be wrong. Mm-hmm. Mm-hmm. You have to dare to be different, because how can you distinguish yourself from the mass of investors if you don't behave differently? And you have to expose yourself to the risk of being wrong, because if you manage your money saying, "Well, my goal is to never make a mistake," by definition, you can't be great, because you have to hedge every question. And so, you know, one of the biggest decisions for a family office, for example, is, are you happy with the conventional moderate return earned safely and dependably, or do you want to be great?
Right.
And if you want to be great, will you take the chance of being wrong? So that's one of my favorite memos, and I'd encourage your clients to take a look.
Thank you, Howard. That was just fantastic. I can't thank you enough for joining us today, for sharing your incredible insights with us, and really appreciate your generosity of your time and your wisdom, and hope we can do it again soon.
We can. And Mo, your good questions bring out good answers.
Thank you.
Thank you.
And for all our, sorry, go ahead.
I was just going to say good luck in your mission.
That actually is a perfect segue to thank all of our participants. Thank you for joining us. And if you haven't yet donated, please do help us with our mission. Please go to the donate page at the top right of the site, so that we can continue strengthening healthcare in our communities. Howard, thanks again for your support of Lunches with Legends. We are so grateful for your participation, and wish you and everyone on the call a wonderful day. Thank you so much.
Bye-bye.
Take care.